Welcome back to Freedom Finance with Lanny, guys. Today we're going to do just a little bit of a conversation with your boy here, guys, and talk a little bit about the Federal Reserve Bank and what the Fed meeting they just had last week here in March, regarding interest rates. Obviously, we all know, and if you don't, they kept rates the same, and they have two more meetings coming up before they close the first half of the year. One towards the end of May, one at the midpoint in June. So I want to talk to you guys just about what you could be doing right now with your money. Whether you want to stay in cash and still earn, whether you want to stay in cash and still earn, but retain liquidity as well. And what it might mean in the mortgage market for all you home buyers out there, what it might mean in the stock market for all you equity investors out there, and just in general, what we could expect from the Federal Reserve Bank regarding interest rates and what Powell might do for the rest of 2024 and 2025. In case you haven't read some other headlines or news, again, you're going to hear it from me because this is the industry that I love. Obviously, I own a house. I'm looking to buy a house. I've been investing in the stock market for, again, going on 15 years here. And, I work in the banking industry, guys. So, definitely grab your favorite beverage, your beer, your liquor, grab some water. Maybe it's hot coffee. Maybe it's hot cocoa like your boy, guys. Yes, I'm drinking hot cocoa today. No jokes here, guys. Don't make fun of me for this hot cocoa, hot chocolate. Call it hot cocoa because people have been corrected me since I use unsweetened hot cocoa, no sugars added or anything like that as my alternative to coffee. Yes, I know there's some caffeine in here. If you guys don't know, I'm almost 3 months in of no coffee, but I do about a cup of hot cocoa, every once in a while just to keep me warm up here in Cleveland, Ohio. Because yes, we had snow this past weekend, and yes, it's still 25 to 30 degrees, guys. Oh yeah, and get your wine, guys, because you're Italian and it's the weekend, baby. And let's dive in to what the Fed just, announced and what they may announce coming up. Let's dive in. All right, guys. So the Fed, they didn't say too much different from their last meeting. In fact, it really wasn't any different at all. They did keep rates the same. 5.25% to 5.50% is the target federal funds rate. And that's typically what you're going to see from what institutions can borrow through the overnight borrowing at the Fed. So if you're a Chase and you needed money right from the Fed, you're going to be borrowing at that Fed funds target rate. Obviously, they have to lend it out at a higher rate, right? Now, what they did indicate, though, and what the Fed's dot plot, which you might have heard of the dot plot, and for those that don't know, the dot plot really is just taking estimates about where rates are going to be over the next few years. And back in December of 2023, they actually projected 4 rate cuts in 2025. Now they're actually projecting only 3 rate cuts in 2025. I get it, but we're in 2024. But that was really the only difference. We're still more than likely, based on what we've heard and what we've seen and what we've read and what I see on the CME website as well, which is where I go, and I'll put a link in the description to see what the probability is for what the federal funds target rate is going to be throughout each meeting, is that there's going to be 3 rate cuts this year, guys. The first one more than likely being not in May. May right now has about an 87 to 88% chance of the same instance from March, keeping it flat. June 12th is the meeting where we might see a 25 basis point or 0.25% of a rate drop. So remember that 5.25, and then they'll be going to 5, but it's on a scale. So 5 to 5.25 from where they're at now at 5.25 to 5.5. Well, what does that really mean? Well, let's talk about your cash. Let's talk about the money market people out there, because you guys all love the money market accounts, right? Why would you invest? Why would you do anything if you could just sock everything you have right now into a money market fund? Well, those good days might be fading away. because once the Fed drops, And usually it always happens. The institutions are smart enough to, slow them down before it happens. You might have already seen some of your savings, your high yield savings account rates drop. I know Ally just dropped their money market rate. I know SoFi is still hanging tight at 4.6. So Ally's got the 4.35 and 4.35 on the savings and money market. But what's going to happen is you'll start to see, instead of getting 5% on your money overnight, it'll probably drop. Because why would Fidelity give you 5 when it's costing them 5? So, again, they're going to drop it. More than likely, you'll see when they drop a 25 basis points, you'll see a 25 basis point drop. So keep in mind, if you're a cash investor right now and you really love keeping cash, you could think of 2 things right now. And I even put it on Twitter as well. Again, my link to my Twitter handle is in the description. Follow me at Freedom Finance, guys. Let's go. Almost 10,000 strong on there. I love it. Appreciate your guys' support. If you don't need the cash, lock it in a CD now. I'm already seeing rates drop on CDs. Over the last probably 30 to 60 days, rates have been dropping. And really, rates on CDs are really built on 2 things. One is, do they need liquidity? So like Flagstar, NYCB, obviously they need liquidity, so they're still offering like a 5.5% 7-month CD. But it's also based on just, hey, matching what the Fed's doing. So those rates will more than likely drop. So if you want to lock in a rate, go as long as you can, maybe, go up to 5 years if you want, lock in something well over 4.25% if you can. If you like to keep it short, probably now is your best time to get that 12, 13, 18, 24 month CD as well. If you do need the cash, but you love that money market rate, look at no penalty CDs, guys. It gives you the freedom of both. One, to redeem your CD early so you can use it for when you need it. We have our down payment fund right now in no penalty CDs because we want the liquidity for when we actually find a house in this wild real estate market, but we still want to lock in a higher rate and earn at a higher rate despite what the Fed does. I know Ally and Bank on CIT, I believe they offer no penalty CDs. Maybe Synchrony offers a no penalty CD. But what I recommend, and I'll put it in the description, is actually a site called Raisin, or formerly known as Save Better. That's where I keep everything. I'll put a little referral if you guys want to. It's in the link. Appreciate the support there. But banks and credit unions go to this platform because the consumers go to this platform to find all of the no penalty CDs that are available out there. And right now, I think I see a couple 5.25 no penalty CDs for about 5 months. So when you think about it, you probably won't be able to, find that, in 3 months, right? It's going to be way lower. So you can lock in now. There are some longer, no penalty CDs, and I'll put a screenshot up here during the video. So something to think about. But what also is going to happen? What's going to happen with the stock market? The stock market already took favorably to the last Fed meeting. And when borrowing costs go down, the Fed funds rate goes down, hence borrowing costs go down. What do you think corporations like? They love lower borrowing costs. Obviously, they're not going to be rock bottom like we saw in 2020, 2021, even parts of 2022. But the market reacts favorably because the trend, the future, 2025, 2026, it's given indication that, hey, we're going to be able to borrow lower because you can grow faster. Your return on that borrowing cost is going to be greater than what it costs to borrow. So the stock market usually should react favorably because the cost of borrowing is less, profits go up for companies. So, I know everybody's like, oh, why would you invest in the stock market? Again, I have to reiterate, stock market was up 24% in 2023. You may have earned 5% in 2023 on your money market, but you underperformed by 19%. The stock market is up through March 22nd by about 10.3%. So you could earn 5% again in 12 months, or you just have missed 10% returns in less than 3 months. Not here to give recommendations or professional advice, but you probably can tell the difference, which one is greater than the other. So when rates really start to adjust downward and inflation is cooled off, the stock market is going to react favorably, because not only are the borrowing costs for the corporations lower, so they can borrow, invest, grow their product lines cheaper to have a better return. Do you think consumers should also have more disposable income to spend? Yes, more than likely. Auto loans should drop, as well with the Fed dropping rates. So think of auto loans, secured loans. Now, the mortgage industry is a little bit different. It's typically tied to the 10-year treasury rate, because when you think of a mortgage loan, it's not like an auto loan, even though auto loans are getting longer and longer. But mortgage loan, it's like your cookie cutter 30-year fixed rate mortgage. So it's usually tied to a longer product, right? Can we all agree on that? And typically they peg it to the 10-year treasury. The 10-year treasury back in October was about 5%, October of 23. And I think that's when the 30-year mortgage rates were pretty much near 8%. And now here we are, I think it's around 4.2% on the 5-year treasury, so down about 80 basis points from October. And I think mortgage rates are around that 7.25, right? 6.75 to 7.25 to be conservative, depending on what institution you look at. So, not to say you use like a +3 average, you can add a +3 to the 10-year treasury, but, if the 10-year treasury dips down, which I expect it will, possibly, again, this is just from my perspective, if rates do come down by the summer, you might be able to see maybe like a 3.8 to 4% range, which would give you, somewhere in the 6.5 to 7% range on the mortgage rate. But hey, it should be lower, but not dramatically lower like you might see on some other loan products. So again, consumers might be able to buy more, might be able to buy those cars, might be able to buy those goods and services from retail, might be able to buy those houses that they've been all pent up, like myself, just to save an extra couple $100 a month on the mortgage payment. So just really keep that in mind, which again, that boosts performances of companies. Stocks typically should rise. In 2024 specifically, again, 67% of the time, if you guys remember my other videos, if you haven't, definitely check them out. 67% of the time, the stock market returns favorably after a 20% plus year performance. So again, 2023, it performed over 20%. So there's a 67% chance that 2024 will finish an up year in the stock market. It's already up 10%. And then the percentage is even higher that the stock market returns positively in an election year. So you kind of take both of those and go, okay, the stock market, it could go down by the end of the, between now and the end of the year, but more than likely it's still going to finish greater than a 0% return for the year based on all circumstances that I am seeing. And again, you should still see future performance, right? Especially with the artificial intelligence or AI boom that we're still going through, or bust that could happen later on. So that's kind of my take. Again, I just wanted to summarize what the Fed plans to do. Again, more than likely a first rate cut here in June, and then possibly 2 more to end this year. Everybody's estimating 3 cuts in 2025. Your money market and high yield savings accounts will start to come down if they haven't already. So I'm giving you 2 options, at least letting you know about 2 options that I would suggest. Again, do your research, but lock it into a CD if you don't need the funds, but you want to keep in cash. Go to the no penalty route to lock in the rate, but still have access to withdraw. Again, this is why I echo, and you've heard me now for over a year, talk about consistently investing and staying invested in the stock market. I have never not said that. I'm pretty damn sure. If I have, you let me know in the comments. So staying consistently invested is key. because you could have stopped in 2022 thinking, oh, it's going to be another bad year in 23. Maybe you invested throughout mid-23 and you're like, all right, it's too hot, I'm going to cool off. And then you miss the back half of 23. Maybe after 2023, you're like, okay, the stock market can't go any further higher. And then 10% just happened. So I buy every single day, every single week into ETFs, no matter what. So highly suggest that, you don't have the magic 8-ball. You can't time the market. Just stay invested. Don't make any knee-jerk reaction moves. Continue to buy what you can. And then just know that, hey, based on everything, 2024 should still finish off on a positive year. Again, we can circle back maybe this time next year if it wasn't. Let me know what you guys think. What do you think about the Fed's comments, about the Fed interest rate cuts, and what it'll do to the economy? Let me know what you guys think if we're going to see rate cuts starting to happen in June, and how many do you think we're going to have happen? Do you think the stock market will continue to grow higher than the 10% return we've already seen this year? And do you think it's going to be a favorable mortgage market and real estate market for us home buyers that are looking to buy that house? Appreciate you guys' support. I love the feedback and discussions we have in the comments. This is what it's all about. All about making small money moves, bettering your personal finance situation, whether that's making more money, making sure we all stay invested to get returns, building passive income, and just staying in the know with what's happening in the macro economy here in the United States, guys. Don't forget to subscribe. Definitely like the video, guys. Show some support here for your boy Lanny, and I will catch you on the next one.